3, 2, 1. Blast off.
All right. We're just about halfway through 2021. We were saying that the other day, I think, but
It's crazy.
and it's getting pretty close now. 27 June.
Yeah.
That's good. July 4th is coming up. One of my favorite holidays.
It's one of my favorite times of the year.
Yeah.
It's always a good marker to know you're really in the summertime.
That is true. That is true. Looking forward to it.
What you got for us this week? Been a crazy week, huh?
Yeah. Actually, I got to apologize up front if this show is a little bit disjointed because I got so many charts rolling through my little brain. I'm not sure what. Bless you. I'm not sure what this is going to look like as we put it all together, but that's okay.
I muted my mic. Hopefully nobody heard me sneeze.
Okay.
Just you. All right. What do we got?
All right. So the market this week definitely was a breakout for the stock funds. Tech is on a comeback. We're going to take a look at that first. C fund was not down. That was a mistake. C fund was up 2.74%. S fund had a huge week, up 4.02%. I fund was up 1.86%, and the F fund was off a little bit, 0.37%. So what do we mean by tech is coming back? No, I did shuffle the slides. I thought I was going to do that next, but I'm going to do this first. So the show this week, tech is coming back. We're going to do a ratio chart of the S fund to the C fund. S fund, as we know, is mid to small cap tech companies generally, and the C fund is a pretty good percentage of big tech, but also a bunch of industrials and other things. So when tech as a whole is coming back, it will push the C fund higher, but on a relative basis, it'll push the S fund higher, more high than the C fund. All right, so we're going to take a look at that. Then the I fund, this is going to be kind of an interesting part. We're going to look at June 2022 to June 2002 to June 2009. A lot going on there in the I fund during that time period. We're going to actually look at the whole thing and then take a little chunk of it, and then look at does history repeat itself? We always talk about how these patterns keep repeating over different time frames, and whether they're indexes or individual stocks or whatever. And that's also going to roll into the bonus chart, which is not the Grayscale Bitcoin Trust. This weekend is going to be Bitcoin versus the US dollar. So basically the chart of Bitcoin. We talked about last week, I was looking for one more leg down, and I'm still thinking we're going to get a little bit lower, but I'm not waiting too much longer to pull the trigger on Bitcoin. And then we're going to stay with the weekly charts and look at 18 months weekly. If you're a subscriber to the site, definitely take a look at the newsletter this week. We're going to go into 6-month daily charts and some of the indicators that we're going to kind of gloss over a little bit on this webinar, podcast, whatever we call this thing. Okay. So, S fund versus the C fund. All right. $DWCPF is the S fund, right? And so imagine it's the ratio of the S, right, divided by the C. Okay? So what that means, the ratio means if the S fund is in the numerator, then if the line is going up, the S is either increasing faster than the C, or the S is decreasing slower than the C, right? So just so we get a good perspective about this thing, this isn't a price chart. It's a chart of the ratio. So when the trend of the ratio chart is up, it means the S fund is doing better than the C fund, okay? When the trend is down, it means the C fund is doing better than the S fund relative to each other. So they could both be going up or they could both be going down, but relative to each other, when the chart goes up, S is doing better than C. When chart goes down, C is doing better than S. So why does this have anything to do with anything? Because we've ticked back up here to S outperforming C. So what that means is S is basically all tech. C is not all tech. It's a good chunk of it, but it's not all tech. So we can, among other things, we can pull out from that tech is on a comeback. And so if I was trying to decide which funds I would want to be in, I would consider being more weighted in the S fund than the C fund at this point, because we've had a pretty good correction on a relative basis, right? Again, on a relative basis, we had a pretty good correction from February to the middle of May. The S fund was underperforming, and it's just started to outperform the C fund. So if you're trying to figure out which funds are the best, if you're going to be in the stock funds, you're trying to figure out which stock funds to be in, this is kind of giving you a clue. Okay. So what I tried to do with this, I was thinking through. Here was the premise of my thing, what I'm thinking through. We have been going sideways on the S fund since almost the beginning of the year. Usually, so sideways, kind of relatively, right? It's up and down. We've had a S fund has been rough for this year, but overall for the year, it's been basically flat. That is not indicative of a top. A top rolls and the patterns look different. We had a huge run up from the bottom of COVID, right? And then for the past like 8 months, it's going sideways. It's not indicative of a top. So I started to go back through some charts to try to figure out, is there an example of something in the past that looks something like what we might see going forward based off of a huge move off of so we had a big drop from COVID,
Mm-hmm.
and we had a huge run up following it, and then we had this 8-month flat. So I went back through a bunch of charts trying to find that a similar scenario.
Something similar,
right? And then what happened after that. So this is not the first time we're going to look at this chart. Next week we're going to do sort of the other half of the chart. So what I'm going to focus on in a second is this piece right here. But before I get to that, before we zoom into that part, here's the I fund from June 2002 to June 2009. Okay. We had a major low, everybody knows, down here at the bottom in 2003. It was the bottom of the housing crash and financial crash and all that. We actually had a double bottom. We had a bottom in the end of 2002 and then a final bottom at the beginning of 2003. So here's a couple things to look at with that. The 2003 low in price was actually a little bit lower than the 2002 low, right? But while that was going on, you had a positive divergence in the MACD. The MACD on the low in 2003 was higher than the low in 2002. That's a positive sign. Same thing with the relative strength. The relative strength was lower, not by much, but it was lower at the low in 2002 versus the low in 2003. So it's a bullish divergence. The momentum is turning up, even though price is still going lower. So it means we're almost at the bottom. Then we had this huge run. We've talked about it before. A lot of people made a lot of money over the 4 or 5 years there from 2003 to the top in 2007. And all you really had to do, once the 10-week moving average crossed up through the 50-week moving average, if you rode that 50-week moving average up, you made a ton of money. All right. Next week, we're going to talk about this part. Okay, because obviously you lost a ton of money. Almost all of it. We had a low down here in March of 03, 1746, came up to a high of 56.60, and all the way back down to 21.85.
I mean, you only lost it if you were still in it.
Yeah, right.
So we weren't in it.
No.
Just
I
want
can't remember.
Just want to point that out.
No. Yeah. This is we're going to go back to this chart 3 or 4 times throughout the presentation here, but there's a whole ton of things to talk about, and I have too much in here to really go any further than that about the overall chart. So I'm going to kind of zoom down. But I just wanted to point out the bullish divergences on the MACD and the RSI. And once we have the crossover, we're good. Okay. So does history repeat itself? So we said we're going to look at this part of the chart going forward, right? So here's that part of the chart. We had we were like up here. We came down to the bottom in 2003. Then we had from 2003 to the beginning of 2004, we had this huge run. And then we had a flat for whatever, 8 months, pretty long flat, until we had this breakout right there. So if we go back, let me see. No, I don't want to do that. If we go back to this chart for a second, this is where we are right there. Okay, right there. So the question is, if history repeats itself, and this is where we are, then we got a long move higher, right? And it's basically because we had a major low right here. Major lows on the RSI and the MACD. Does history repeat itself? Are we going to see the same thing going forward? Let's see. This is the I fund, right? 2002, December 2002, hit that low to September 2004. Here's the NASDAQ, okay? Not the I fund, but the NASDAQ this past 18 months. Kind of looks just like that, right? That's why I'm saying, does history repeat itself? We had a major low. We had about a year of a huge run up, 8 months or so of a flat, and then a big pop. We had a major low from COVID, about a year run up on the NASDAQ, about 6 months of a flat, and a big pop. Does that mean we're going to still have a giant move higher? I don't know. But the technical indicators also kind of support it. So here was the I fund back then. You get the MACD crossing over on the breakout. You get the slow stochastic just pushing to overbought. You get the MACD here just about to cross. We get slow stochastic just getting to overbought. There's a whole lot of similarities. Doesn't mean it's going to continue higher like it did, in 2004 and follow on into 2007 and have this giant move higher. But this kind of consolidation, flat consolidation, is not indicative of a rollover. So we'll see what happens. I really wanted to see this breakout right here. And I think we pretty much got it. We'll have to see how it plays out, but I'm pretty bullish at this point. Okay. Bonus chart was Bitcoin. We talked about the Bitcoin Trust last week. It sort of mirrors Bitcoin in general, but here's what I wanted to look at. We had the top in Bitcoin like $65,000, almost $70,000. Then we had a 1, 2, 3, A, B, C, D, E for 4. And we're in the fifth leg down right now. The only question is, how far down does the fifth leg go? Ordinarily, this 3 leg is a 1.62 extension versus the 1 leg. And when that happens, you usually get what's called parity between the 1 leg and the 5 leg. So there's a good chance that the one leg is the same length as the 5 leg. So somewhere around $25,000 maybe. It doesn't have to be parity. It doesn't have to get all the way down there. If I'm going into the summer and I'm going to be on vacation, but I know come October I want to be in Bitcoin, now might not be a horrible time to buy it. I'm not buying it yet because I'm thinking it's going lower and I'm watching it really closely. So I'm not quite buying it yet, but it's close. So what does this chart also kind of look like? Back to that iFund chart, right? We had a high up here. We came down for 1, 2, 3, 4, 5, and then it exploded higher. So the patterns definitely repeat themselves. In this case, the iFund index has nothing to do with Bitcoin, but the patterns are very similar. So where we are right now, relative to the 4 line, so 1, 2, 3, 4, 5 is not quite there yet in terms of this 5, but we're close. And you can kind of see this 1 and this 5, same length. It's going to be very similar to Bitcoin. Okay. TSP funds. C fund, SPX, S fund, DW, CPF, I fund, EFA, and F fund, AGG. All right. So the C fund, let's kind of zoom in here a little bit. We've had pretty much a flat on the C fund, 4250, really. It's been kind of running that 4250 line since May. Since that high in May, it kind of hasn't been able to break out until this week. We had a pretty good breakout this week. Lower volume than last week, which is not great. But it's definitely a breakout on the C fund. And if we went back and drilled down into which components of the C fund drove that move higher, you would see, of course, it's tech. Because as we did on the first slide, tech is outperforming the C fund. So that's another way of saying that is the tech components within the C fund is what's driving the C fund higher. So let's get out of this. The one other thing I wanted to look at on this is this new indicator. I think we talked about it last week, but I'm not 100% sure. So I think this is going to be valuable going forward. That's why I'm kind of adding it to the list, but it's called the Silver Cross Index. So the Silver Cross Index is the number, is the percentage. It's not really the number because this goes from 0 to 100. It's the percentage of stocks in whichever index you're looking at, right? So in this case, it's the S&P 500, where the 20-day moving average is above the 50-day moving average line. So for the index to continue higher, more stocks need to be above the 50-day than below the 50-day. So if the 20-day moving average stays above the 50-day moving average, then the trend is higher and the index will keep moving higher. The price will keep moving higher. If there's a decrease in the number of stocks that are where their 20-day moving average is above their 50-day, then you'll get a decrease in the line. And if the line starts rolling over, it means the companies in the S&P 500 prices are going down. So it's more of a fundamental analysis kind of way of looking at this thing. But when you put it on the chart, you can see, which kind of makes sense, right? The COVID crash here, obviously all these companies, their individual stock charts, as they rolled over, their 20-day moving average line crossed down through their 50-day moving average line, right? And this line represents the percentage of stocks with the 20-day above their 50. So as that decreased, this line started decreasing. So then when we hit bottom after the COVID bottom, once prices started recovering, you see it in this chart. So more of those individual stocks in the S&P, their 20-day moving averages are getting above their 50 days. So this line starts going up. So we kind of peaked out right here, and then we had basically a flat for a long time as price continued to go higher. Right? So once the percentage of stocks, say in this case it was like 80, got above about 80% of stocks within the S&P 500, their 20-day moving average was higher than their 50-day moving average. It basically stayed flat for a while as price continued higher, which is fine. What I was looking at back here in May was this turnover. Because once the underlying stocks in the S&P 500 started rolling over, even though price was kind of flat, it gets to be kind of a concern, because if we know the underlying stocks are starting to roll over, we can expect price to start to roll over with it. And we saw it a little bit, right? Because we had a top here, and then price basically went flat for a couple of months. And that's where we got this, we got a little dip and then a flattening of that curve. When we get to the daily charts in the newsletter this weekend, you're going to see that this line, although it looks like it's continuing lower, on a daily basis, it's actually starting to turn back up the other way, which is a good thing for us. S fund. Again, it looks just like the I fund from 2002 to 2004. You get the low here from COVID, you get a big run up, you get a flat, and you get the breakout. MACD is about to cross higher. Slow stochastic just went overbought. As you can see back here, when the slow stochastic gets to overbought, you still got plenty of room to run higher. And in this case, this is I put in here the NASDAQ's version of the Silver Cross, because they don't have the index, a Silver Cross index for the S fund, but it's similar, because the S fund doesn't track the NASDAQ, but it's tech, so it's kind of similar. So we've already started seeing the NASDAQ Silver Cross index turn higher, which is consistent with the breakout, which is consistent with the NASDAQ chart that we showed a while ago. So tech is definitely on the comeback. Yeah, that's why I put that in there. So S fund chart right now versus the I fund chart back from December 2002 to September 2004. Very, very similar. Okay. I fund, not so much. How come we didn't get a breakout in the I fund? I don't know, a month ago or so maybe, we did a show about the comparison between what is in each of the funds. The I fund is not tech heavy. Back when the S fund back here was consolidating, right? The I fund was moving higher. So the I fund was definitely outperforming the S fund back when tech was consolidating. But now that tech has broken out, we would expect that the I fund, because it's not tech heavy, is not going to break out in the same way. And that's what we're seeing. Okay. F fund, of course, is a completely different animal. The interesting thing here, slow stochastic can get overbought pretty quick, and price can keep moving higher. Because we talked about last week, the slow stochastic is a momentum indicator. It's telling you how fast, how powerful price is moving, basically. So even though the momentum can come down, price doesn't have to come down with it. It can stay flat. And then the F fund bottomed out, and it's been inching its way higher ever since. We talk about all the time. The F fund is really, I'm not in it very often because it's just not volatile enough. But right now, I think it's in a better position than the G fund because it's definitely still getting support at its 10-week moving average. And until that changes, it's a better place to be than the G fund. I think that's it. There's 3 trading days left in the month of June.
Yeah.
So in terms of tactics, if you've used one of your moves for the month and you want to add to your position or change your positions or whatever, you can still do that. I'm looking really closely at that. The S fund is outperforming. We did one move already. We could definitely do another move to be in a better position going into July.
Yeah, wish it had happened a little earlier in June, but market is what the
does
market
what
is.
it does. Yeah.
But it's great to be able to play. Get into the month, have 2 moves, really 3, if you want to get out.
Yep.
But we'll see how July looks.
Yeah, it's interesting because in the back of my mind, July and August tend to be super volatile.
Yeah.
But when you're looking at weekly breakouts on the S fund like we saw, you got to go with the markets. I have to go with the markets, what it's telling me to do. That's just the way I roll.
We need you to do that. You stick with that.
Yeah.
All right, man. That was a good one. We packed in a whole lot of info and hit about 30 minutes. Hope everybody got a lot of good value out of that. If you did, please share it with your friends. Let us know. Put some comments in there. Catch us on YouTube every week and on our Facebook page, Facebook groups. You ready to get out of here?
Ready? I'm out.
Let's do it.